Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the subscribers and comments. I greatly appreciate it. This channel just passed 10,000 subscribers. I can't believe it. It's been an amazing ride, and I look forward to this year 2021 and covering more stocks that you like to see and that I like to invest in. Today, we're going to look at Altria Group, the domestic, being the U.S., here I'm in the U.S., domestic Philip Morris half. When they have the business, you've got Philip Morris International, you've got the domestic business, which is rebranded as Altria Group many years ago. Let's take a look at their financials, see what they're about, how much money they're making, and what we think the value might be. So before we dive into these numbers, I want to go through the 5 key attributes for all investments that we look for here at this channel to underpin our investment. And that would be top-line revenue growth, EBITDA growth, strong free cash flow, low debt being less than 3 times debt to EBITDA, and a well-priced stock being enterprise value to EBITDA. Okay, let's take a look at Altria Group financials. All right, behind me is their 2019 10K, their annual report. These numbers are in millions USD as of 2019. December's the fiscal year, and they will actually put out a brand new 2020 report here shortly. This is filmed in January, so it'll take them usually about another month to get the full report out, but we're going to go off these 2019 results and go forward. But I want to point out a couple things. One, revenues $25 billion, excise tax $5.3 billion. When I state the numbers in my sheet, you're going to see it. I'm netting the excise tax with the actual revenue. So you're going to see a revenue about $20 billion, which is the net of those two, FYI. But what I wanted to point down is the massive write-down and the impairment that they have taken for the Juul investment that's currently, that they own about low 30% ownership of the company. Juul is the vaping e-cigarette company that has received lots of litigation recently, and as a result, Altria Group, which owns roughly 33% of the stock, is going to write down the investment that they're carrying. So this is going to be a non-cash charge that affected the income statement that we're going to add back to the EBITDA because it's not an ongoing material part of the business. You can also see this if I actually go to the assets on their balance sheet for the Altria Group, and you scroll down to investments in equity securities. You can see it was roughly $30 billion, and it was written down or reduced to roughly $23 billion. That drop in asset value results in a charge in the income statement that I just showed you of $8.6 billion. So they had an asset on the books. They looked at it and said, you know what, with all the litigation that's coming out on Juul, maybe this isn't worth what we think it is. We're going to write it down, lower the value. That lowering of the value hits the financial statements, and that's why their earnings in 2019 were negative. Let's go to my sheet, and we'll take a look and see what we think this business has done over the years and where it might go in the future. Now, everything in here is millions USD, and I was shocked when I looked at this. 2011 to 2019 fiscal year-end numbers, $16.6 billion, growing to $19.7 billion, almost $20 billion of revenue. That's a 2% annual growth rate, which, if you asked me in 2011, would Altria continue to grow, I would say no. That I would have thought tobacco, litigation, less smokers, customers perishing. Why would this company continue to grow? It mainly, I think, price increases on the existing commodity that they sell, but it's still interesting to see them grow, and technically does check our box. Another interesting one is the EBITDA. The EBITDA has gone from $7 billion to $11 billion. $11 billion, that's a 6% annualized growth rate for the tobacco giant. Again, checking our box. Let's keep moving and look at our enterprise value buildup, what we believe the business itself is worth in its entirety. And that would begin with the debt column. Here, we've got debt of $13.6 billion, up to $28 billion. That's a doubling, a little bit more doubling of debt over this period of time when EBITDA has about doubled. So it looks like debt is staying in line roughly with EBITDA. Market cap is shares outstanding times price, average price, 66 billion to 80 billion. Market cap has really not moved at all. Debt has gone up, debt's doubled. So you're seeing the enterprise value, which is debt plus market cap less excess cash. Debt has gone from $80 billion to $106 billion over this time frame. That increase is predominantly the increase in debt. And so when we look at our ratios of value, we'll do debt first. When we look at the ratio of debt, it's hovering around 2 the entire time. So as I explained earlier, EBITDA has grown. EBITDA has doubled over this time period. And the amount of debt that they're carrying has also doubled. So this ratio of net debt to EBITDA hasn't really changed. Still under 3 in the entire duration that we're looking at, which is our benchmark for low risk, which is good to see. It seems like it's a little high recently from the debt that they used to acquire the Juul investment. They're still paying that off and writing it off, so it wasn't the greatest investment for them. But it's still under 3 times, which really is what we're looking at to safeguard our investment. The big one that we look for, right, is well-priced. How do we define what a well-priced stock is? Well, this is one of the metrics you can use. You can also, obviously, the free cash flow yield would be another way of benchmarking the value. But here, it seems to hover. 16 times would be a high, 11 and 9. It's currently, in my pricing, 9.3 times, which is kind of actually it is an all-time low for what we're seeing, which is remarkable for such a kind of, steady state, kind of a dividend company. But 9.3 to me looks cheap for this business. Let's take a look at cash flow and see if the cash flow matches the EBITDA. All right, so here we are with cash flow, $3.5 billion to $7.8 billion over this time frame from 2011 to 2019. That's a 10% annualized growth rate, which does in fact smell check with the EBITDA growth rate that we were seeing. So that's good. It is cash. The EBITDA is translating to cash. And you can see when I commented earlier in the channel that the negative earnings they experienced as a result of the write-down for the Juul investment, the $8 billion, we added that back into our EBITDA because it was not cash. And you can see this is almost $8 billion here, which is pretty consistent with historical pattern, and it's positive, meaning the write-down was not cash. So the $8 billion that hit the P&L, that produced a negative earnings on the financial statements, on the income statement. When you look at cash, what really matters, the rubber meeting the road, cash, money, it's positive. We didn't have to add anything back because it wasn't a non-cash charge. Free cash flow from operations looks strong. CapEx is absolutely tiny. It does not take them very much money at all to maintain their businesses. So when I take the net of these two, I say, okay, you made $7.8 billion in that fiscal year. You only had to put $250 million back into the business. That produces a tremendous amount of free cash flow that can go to the actual equity holders. The debt piece, before we get to the final comment, the debt piece, it looks like they did borrow here for the Juul investment, and they borrowed again last year slightly. Previously, they did not borrow much at all, and I think that's why you're seeing the debt over time that we said did grow, because most of these are positive, but it's growing in line with earnings and cash flow, so it's not a concern. We're not in jeopardy of becoming over-levered. They're not using cash to pay dividends they're not using debt to pay cash and buy back stock, which is a fake way of showing earnings growth. This is real operating income and real cash flow growth, which is the hallmark that we look for before considering anything else. So I think I'm okay with this. When I look at the free cash flow that's available to the equity holders here, that to me looks strong. This $20 billion obviously was not fully available to the equity holders because it came from a huge chunk that was used to buy the Juul investment. So when I take the 11 or 12 billion, remove it from this 20 billion, that's roughly half this number, roughly half, right? So that means that the cash flow per share isn't 1060, it's more like 5 and change because it's halved this number. That means my yield here in this year of 21% really is about 10%, which is in line roughly with what we had here of 12%. 12%, of course, being the $10 billion of free cash flow to equity last year. Got shares outstanding, gives me a free cash flow per share of about $5. So I think these 2 years, it looks like you're in the 5 and change range of annual free cash flow. Depending upon where the shares trade, gives me my yield, and you're looking at a strong double-digit free cash flow yielding stock that appears to me to be cheap in the low end, if not the lowest of its trading range in a long history. So I think that's a very interesting entry point for a company that produces a tremendous amount of cash and has very little debt. The other thing I want to show you is what are they doing with their cash? Well, they're buying back stock. So had you bought it, 2011, you would have had roughly 2 billion shares outstanding against the one share that you had, or however many shares you bought. And then over time, as the company has bought and canceled those shares, that's exactly what they're doing. They're reaching into the stock market. They're saying, here, I'll pay you $37 for whatever the difference here. That looks about 32 billion shares. So buy 32 billion shares at this price and just rip them up. They're gone. That means that the rest of these shares are the only shares that own the company. So the free cash flow that it produces now has fewer shares to lay claim to this cash. So your cash ownership of the business goes up. And they have been doing this steadily for almost a decade. I'm sure if I went back, it'd probably follow the same pattern. But they've been doing this consistently. It's roughly 1% on an annualized basis as they go through the time. So they are taking their cash, they're kicking it out as a dividend, they're using it to buy back stock, which is a tax-free way of providing a dividend to the investors, right? If you get a dividend, there's dividend tax that you must pay. But if the company itself buys shares in the open market, cancels them, your ownership interest in the business grows and you don't pay any taxes. That is a huge, huge advantage when you're holding a business long term. It's that incremental ownership creep if they are judicious and honest about how they treat the equity holders. If the equity holders are like a partnership where they are not diluting you and issuing stock willy-nilly, but really very consciously acting for the best interest of the equity holders, and that is to return the cash both in dividends and buybacks and grow. These guys I don't think they can grow tremendously. They tried with the Juul investment. It looks like they're writing that down. Who knows what else they might try. But for cash generation, they make a tremendous amount of cash, and it seems to me like they're honest with how they use it. So ROIC at the far end, actually quite strong, which is surprising for what is a tobacco company. I would have expected it to be less than that, but I mean, it makes sense. They have very low capex. They probably don't put too much cash back in the business. So the equity balance that they have, their capital structure they have is generating a lot of free cash flow. There's a high ROIC. So that is, we've covered revenue and cash flow. Let's go forecast and see what we could generate as in terms of a value. So EBITDA forecast, we'll start here, then we'll go to free cash flow. All right, EBITDA forecast, I'm carrying the EBITDA growth that they've experienced in the past forward, right? Customers, they're selling a tobacco product. It's fairly consistent year in, year out. They're growing EBITDA at 6%. I've called it a 5 to be a little conservative, and I held it flat because 5 is not a very big number, and they seem to be able to pass on costs to their customers quite nicely. So $11.5 billion in 2020, out to just shy of $18 billion by 2029. If I use the average, it's gonna be 11x multiple on this EBITDA number, I get just shy of $200 billion of an enterprise value. Now remember, they're currently trading at 9.3 times, so I'm getting a little bit of a creep in my multiple expansion by buying at such a low multiple. The average was 13 for this period of time. I'm only saying 11. There could be potential upside if that rockets back to 16 for some reason. but I'm not assuming that. I'm just saying, hey, give me 11x for a little bit of an expansion on the market multiple. Less debt, no cash, there's not excess cash. Outstanding shares, this is the current outstanding shares that they have. Divide market cap by current outstanding shares, I get a price. $92 is the future price target for Altria Group based on the EBITDA market method. Let's take a look at free cash flow. You know, my personal favorite. So free cash flow, remember I said free cash last couple years was like 5 and change, low $5 mark. Well, I'm growing that at 5%, so I get about mid $5 mark for the first year. And that grows in line with EBITDA because they're not making material changes to their capital structure. They're not going to put a tremendous amount of money back into the business from CapEx. They don't have a tremendous amount of debt that they have to pay down. So I expect free cash flow to grow in line with CapEx as a result of not having huge debt payments and not putting tremendous money back into CapEx. So I would think these would stay the same on the growth rate, 5.5 to just above $8.5 free cash flow. I use a yield there, which is the average historically. So 7.5% is what I was using on the average yield. Gives me a price target of $117 out in the future for Altria Group. So here we are. Let's take a look at our price chart. We've got free cash flow to equity method. So that's a cash flow method giving me a price target of $117. Again, EBITDA market multiple method of $92. Average the two. We can adjust these if you want, but I'm just saying 50-50 for the fun right now. Long-term price target just north of $100. I've got 104 and change here in 2029. Oh yeah, current price is around $40 a share. Let's put this into an IRR and see what we get. I think this is going to be interesting, and I was really surprised when I saw this. So here's our IRR calculation. I'm buying it at $40. I get a stream of positive free cash flow over the period of time. That cash flow they can use to buy back and tear up shares, which means my equity percentage grows. They can dividend it out. Or they're really gutsy, they can go out and try to buy another Juul with this free cash flow, and hopefully it grows. But I'm assuming they pay it out because acquisitions are very hard to forecast, so I don't try to forecast that. I'm in at 40. I'm out at 104 in 10 years' time when the price has risen, and I get a stream of cash flow that I can do an IRR on. And I get a very healthy 27% annualized IRR. Almost 4.5 times your money cash on cash if you hold it for a decade, which is a very, very strong return for a company that growing very weakly on top line and has decent single-digit EBITDA growth. But for a kind of a lower stock price, with a little bit of market multiple movement showing a very strong investment. And I think this example here is an example of what I call a trifecta. We've got 3 factors really moving the price in your favor. Those factors would be 1, the EBITDA growth that we saw, even though it's single digit at 5%, it's consistent over time, 1. 2, the second factor is that they always buy back shares. I have not bought back shares here. I'm distributing all the cash, but I'm saying historically, their pattern has been to buy back shares, which means your ownership interest is going to grow. And third, market multiple expansion. You're buying it at 9.3-ish, depending upon when you get in, but it's about 9.3 times market value, and I'm growing it to 11 on my EBITDA market multiple. But it could be higher than that. It could be 12, 13, 14, as you saw historically. So that expansion of market multiple means that every dollar of earnings is 10, 11, 13 times market value that the business gets, and your share prices grow. So that magnifies your return. That's how, in the Domino's versus Google, that's how Domino's outperformed Google, if you've watched that video. And I think this is a case for it. The price distribution chart, here's my $40 entry point. As this goes up, the IRR, assuming this pans out, does fall, but still strong double-digit IRR over time. If it should dip again, which I don't think it'd get this cheap, but it's an amazingly cheap investment if it falls under $40. But I like it at 40. I would like it even a little higher if it continues to run. So we're going to give it a good investment here at the channel, right? We are buying cash flow. So let's revisit our 5 key metrics and make sure that they all check the box. Revenue growth, yes. Single digit, but it's growing. EBITDA, growing. Single digit, but strong and consistent. Cash flow, strong. Cash flow from operations was much bigger than CapEx. Low debt, yes, less than 3 times. And well-priced, absolutely. The market multiple is lowest it's been in almost a decade. So I think those 5 key factors line up, give you a nice shot at a stable investment. Last thing I want to say is kind of a market portfolio theory a little bit. You've got your growth stocks that have really high return, high expectation, and could be very volatile. Your Netflix, your Microsoft, your Disney, those companies have very high market multiples, and the market takes a dip, they could come down sizably. Something like this is already bottom of the barrel. It's not going to fall a lot if the market itself falls. So when you look at your whole portfolio as a whole, have some super good, going to be high. You don't want everything that's too high of market multiple, but some things you have to pay a premium for, and you get them. Other things like this can be kind of your rock that kicks out cash over time and is there to help protect your portfolio in a downturn. All right, my name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate the support. Hit the subscribe button, comment, let me know what other stocks you'd like to see. Okay, talk to you later, bye-bye.